You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributor to Backroom Technician. This week on the Biz Income Tax Planning Series for 2013. And on today's show, next steps to paying less in taxes with national columnist, certified financial planner, and CPA, Ken
When
Davis.
it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone, and I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain, and day two with me, Mr. Certified Financial Planner and CPA, Ken Davis. Well, welcome back. Of course, we're with Ken Davis, CPA, and boy, I'm telling you, Ken, I'm looking at, before we get into the three types of income, let's just do a small touch because some things have changed in capital gain treatment. Let's just talk about that because that could affect some of our viewers.
Yeah, I think capital gains are pretty well known, and basically just remember that time is important. If it's more than 12 months held, a capital asset, meaning stocks, bonds, real estate, things like that, then if they have a gain, it's long-term capital gains rates, which we've been taught to believe it's 15%. Well, now those people that hit a 39.6% tax bracket for ordinary income taxes are now subject to a 20% capital gains tax. So that's a big change for those with large sales, like maybe somebody has an apartment complex and maybe each year they have very little capital gain. Suddenly they have this huge capital gain in 1 year. They pop into that higher tax bracket. Now they're going to have to pay
It could be huge.
not only higher income taxes, but also the estate tax, not estate tax, capital gains at 20%. So that's new for 2013. The rest of it stays fairly constant, and there's really not a lot more to report.
Okay, but for people that are up in the upper brackets, that's an issue.
Oh, it's a big deal.
All right, now let's talk about, we've talked about, in the last one we talked about tax exemptions, deductions, and credits.
Yes.
Now let's talk about the three forms of income.
Well, this is interesting. Back in the 80s, when, well, actually in 1979, we had income tax brackets, believe it or not, of 70% for the wealthiest of individuals in the United States. And so people focused a lot on tax shelters. They had real estate, oil and gas, mining types companies, book deals, leasing, all that kind of stuff. That was big activity because people were trying to manage their taxes and they were able to do that. Well, Congress got angry about people trying to shelter their income and squeezed it down more and more. And finally, they got rid of it a lot by changing the rules. And so we actually have personal service income, which is our salaries, bonuses, commissions, self-employment income from your own business. That's personal service, and that's taxed as ordinary income. Then you have portfolio income, such as dividends, interest, royalties, capital gains, and there's certain deductions that you're allowed, against those. And then there's passive income, limited partnership income, rental income, capital gains on passive activities. That was more the tax shelter thing. And so the Internal Revenue Code manages taxation based on categorization first of income. So it's not just income, it's a type of income, which then determines whether you get ordinary income tax treatment, capital gain treatment, and certain deductions against the types of income you have. Because people would create things that would create a loss and then try to offset against ordinary income from their wages. And so they said, no, we're going to cordon this off and say you can take this deduction against income produced by this kind of activity, but not flow it over to these other types.
So on my regular wage, that's going to be taxed ordinary income tax.
Yeah, full income tax brackets.
Okay. But now on the second one, though, you said about capital gain, capital tax is going to be less.
Well, that's right. If you have you own a stock for more than 12 months, and you bought it for $1,000 and sold it for $1,500, you have a $500 long-term capital gain. Now, there's other rules. You offset capital losses, and there's all these categorizations: short-term, long-term capital gains, short-term, long-term capital losses, and there's a formula of how you pair those up and net them out. And this all comes through Schedule D on the tax return, and it's way too complex to be talking about
really
in the
important.
show.
It's really important when you think about it that if you have a portfolio, you just need to learn how to harvest tax gains and losses at the end of the year and let them offset each other. I mean, that's the goal, and that's why you need to have a professional in on this.
Well, yeah, and there are a lot of people that use programs like TurboTax and do it themselves, and what they may be missing out there is they're not getting that year-end tax planning of saying, oh, gee, I've got some losses in this portfolio here that if I sold them, I could trigger some capital losses that would help offset capital gains. We say, well, why do you want to offset low cost gains? Well, if you have short-term capital gains, you held a stock for 6 months and sold it, that's treated as ordinary income for tax purposes. So you might want to have some capital losses to offset that first. And then, of course, what I find patently unfair is that if we have long-term capital gains net, after everything's been added up, you only get to deduct $3,000 against your ordinary income. So you have those capital loss carry forwards, but $3,000 at a time, that's been around for as long as I've been in the business. So $3,000.
No inflation there.
Yeah, $3,000 used to have some benefit. Now it's negligent.
Well, the last one, if people and a lot of people are into holding real estate, so they have passive income. Talk a little bit about that.
Well, yeah, and there's different categorizations. If you are a true passive investor, in other words, you hand money over to somebody else to manage and buy the properties or whatever, you might be a limited partner, or you might even be a partner in an LLC. People don't realize that LLCs are taxed like partnerships. Then those losses are going to be offset against other types of passive income, but there's limits on how much you can carry over, and then there's there are some real estate activities that you meet certain rules that you can do some shelter with, but the old days of going out and going to your stockbroker and buying a limited partnership and sheltering your income is gone.
When we come back from the break, we'll continue our next steps to paying less in taxes, part of our income tax planning for 2013 with Ken Davis. And don't forget to enroll in IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
Living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's materials at thebiz.tv. And while you're out there, click on the Backroom Technician icon for the 30-day free trial offer for access to the best needs analysis and client education materials that address almost every financial planning scenario. And before moving forward with today's ideas on the show, always consult your tax advisor and broker-dealer compliance department. We're taking the next steps for paying less in taxes, part of our income tax planning series for 2013 with Ken Davis. Ken, we want to talk about next steps. We don't got too much more time left of the tax code, so we have to kind of prep our 1040. What are the next steps that we need to look at to really get the most out of, because a lot of people think, well, it's too late for that, Steve, December 31, 2012, but actually that's not true.
It's just the opposite. This is the time to do tax planning, and unfortunately, somehow our culture has gotten in the habit of thinking that December is the time to do tax planning. And yes, you can do some then, but not much. And what I mean by that is you can, if you have an IRA, you can contribute now for this year. You don't have to wait to 2014. And the benefit is you not only get a deduction for 2013, but you also get tax deferral on those earnings for another year.
Well, think about this, because let's go back. December 2012 is over.
Right.
But you can still make contributions to your IRA for 2012. And I think a lot of our viewers and consumers, they don't even know this.
Well, and an old style qualified plan for businesses still is available, which is the SEP IRA, can still be set up and funded. All other qualified plans had to be in place by December 31st. The SEP IRA is the only exception to that rule, and so there's still some planning for businesses wanting to set up plans for themselves and their employees.
And that's a pretty good chunk of money, too.
Oh, it can be a very substantial amount of money. So SEP IRAs can be attractive. Funding for this year's contribution. In fact, you could fund for last year and this year and get it in. And the sooner you get in and get tax deferral, a lot of our focus is on tax deduction, but over many years, tax deferral is actually much more powerful than tax deductions. It's like getting a whole bunch of mini tax deductions. That interest, like say you made 8% return, that 8% is not taxed. That is, in a way, a tax deduction for the earnings. Okay, we call it deferral, but it's in a way a tax deduction. And when you pile those up and then you compound them, there's a period of time where that actually more than pulls ahead of the initial tax deduction. Emotionally, it's more attractive to get the deduction, but the fact is deferral is really important. So the beginning of the year is where you start your deferral process, not the end of the year. Yeah,
we have information that, of course, if you request it, here's the calculation on procrastination. Just that 1 year delay can make a big number and big difference. But I like that we have IRAs, and people that are 50 and older actually can put a little bit more in.
Yep. They can, I think the law now allows them to put another $1,000
on top of the regular contribution.
Right, correct. And so those contribution levels are adjusted for inflation each year. And by the way, for our viewers, inflation adjustment is always good in the tax law, because if you have exemptions or credits or certain thresholds for making computations of taxation, the higher those thresholds are, the better for you it is. And so if those are adjusted for inflation each year, we're better off. It stays with inflation. Over 20, 25 years, what was a large threshold or a high deduction really is almost meaningless after inflation chips away at it.
So if you have room in your budget to put in qualified plan like an IRA, or if you're a business with a SEP IRA, a SEP IRA, this is still the time. You got till April 15th to get this done.
Well, let's not forget that the whole concept of Roth, and it's wonderful that over the years people have become aware of what a Roth concept is, which is no deduction up front, but you get tax deferral in between, meaning your earnings aren't taxable each year, and ultimately at the end they're tax-free. And in addition to IRAs and qualified plans and Roth IRAs and Roth 401k plans, which a lot of people don't know exist, there are certain types of financial products that your financial advisor can bring up that will give you a very similar effect of a Roth, but with higher contribution levels.
Well, let's just go down that road for a second, because I think you just said something about it 2 minutes ago that caught my ear. When we're looking at tax deferral, and the longer I hold, it could supersede a tax deduction.
Correct.
So the longer I hold it, so if I have a Roth, everybody bemoans the fact, oh, the Roth doesn't get a deduction. Well, maybe that's okay because I'm going to be taking it out tax-free. And by the way, little question. Ken, does a Roth IRA, when we take our money out, does that have any calculation to do with our Social Security?
No, and I'm so glad you brought that up, because I was thinking the same thing. Because we talk about, should I do Roth or shouldn't I do Roth, and which is better of the two? Well, the fact is, if tax rates are exactly the same on the front end and the back end, pretty much it's a toss-up. It doesn't matter, okay? I know that's counterintuitive, but that's pretty much it. However, if you assume, like many of us do, that tax rates will continue to rise because of the massive debt that our government has spent, then it's likely we will see higher tax rates. But more importantly, and most of the articles and analysis I've seen misses this on the regular IRA to Roth conversion, is what is the effective tax rate? And what I mean by that is, if you have income over a certain threshold, your Social Security is now going to be taxed. First, 50% of it's included in taxation. You reach another threshold, 85% of it's going to be included, until you've included the entire 85% of your Social Security. Well, if you're taking IRA distributions, that could contribute to that formula that causes your Social Security to be taxed. So if you have a Roth IRA, money coming out, that doesn't go into gross income, that doesn't cause your Social Security to be included. So that by itself may be a reason to do Roth over regular.
And remember, you can watch all our shows by going out to our website, thebiz.tv, and follow me on Twitter, Facebook, LinkedIn, Pinterest, and Google+. Well, that's the Buzz on the Biz for today. You've been in the zone, the Business Insurance Zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.